Hello, everyone. Welcome. Good evening, good afternoon to you from wherever you're joining us from. My name is Nasir, and I will be your host for this insightful session. On behalf of SmartFX, I again welcome you to another episode of our weekly webinar sessions. I promise you, stay with me, come along with me, and you would have a very educative period. It would be 30 to 45 minutes of your time well spent. This I can assure you. Again, I would like to reiterate the goal here is to help you transition from a newbie trader to a professional trader in the shortest possible time. The ideas that would be presented here would be as simplified as possible to, ease your transition from whatever level of experience you might have to where you're really hoping to be. That being said, I would like you to please take some time to follow us on social media, Facebook, Twitter, LinkedIn, Instagram, and the likes. And again, I welcome you. My name is Nasir Mohammed, and I'll be your host for today. This is my mobile number. Feel free to contact me directly if we're not already in contact anyway. Feel free to contact me directly for whatever questions you might have or whatever needs you might have. I'll be happy to assist you with. Now, getting to business, our topic of the day is risk management. This happens to be one of my favorite topics, when it comes to trading, because I see it as a bridge between successful and not successful trading, or professional and amateur trading, if you would like. So I particularly struggled with this when I started my trading journey. And this is one of the reasons why it's one of the topics that I find very interesting to talk about, because I had to do a lot of work on myself, do a lot of personal research to transcend from the point of constantly losing money to the point of, becoming consistent. And I would always say that risk management is that bridge that takes you from where you are and to where you want to be in terms of your trading journey. So just as the word implies, risk management is all about managing your downsides appropriately. One of the key benefits of this webinar series is for you to learn from our experience, not just myself, but everybody else on the SmartFX team. Everyone here boasts, all of our analysts boast of good experience in the market space. So I invite you to please check our YouTube channels. You would see some of the other videos by the rest of our team, and you can learn from all of these things. Now, one of the key things is for you not to make the same mistakes that a lot of professionals made in the early stages. And as they usually say, a wise man learns from other people's mistakes, right? So wisdom requires that you learn from a lot of these things which we will be teaching you. That's the aim of this series. Now, risk management is one of the most overlooked areas in trading, but it is also one of the most crucial for success. And I would give you an example, right? Every time you want to spend money, every time you earn, you have to have a budget, right? You have to know how much goes on your feeding, goes on transportation, goes on, taking care of every of your needs. You don't just earn and then splurge in a single day. No, you manage your finances. Same thing goes with risk management when you're trading. You have to basically manage your finances when you're trading. And the process of managing your finances in trading is what we call risk management. Why is it important? because we are in business of making money. And in order to make money, you have to learn to manage your downside. We all understand, at least to a reasonable degree, that when you trade, every time you get into a trade, you have money on the line. Now, you have to focus on the things you can control and let go of the things you cannot control. One of the key things you can control in the market is how much you're risking per trade. And this basically is key, because if you go into the market with a gambler's mindset, you will eventually hurt yourself, right? So the most important thing is to take every trade with the mindset of, I don't know what will happen. Yes, I mean, you've done your analysis, but there's really no guarantees. So every single trade you take requires that you manage your risk. Ironically, this is one of the most overlooked areas in trading. Exactly. Many Forex traders are just anxious to get right into trading with no regard for total account size. You know, I've been there and I've done that. And that's why I can tell you with all confidence that this does not work. If you go into the market only thinking about how much you want to make, you would always come out crying. This I guarantee you. So I don't know how many different ways I have to say it to you, but please take my advice and manage your risk correctly and consistently. As we progress in this session, I will show you some of the ways in which we can do this. Now, they simply determine how much they can stomach to lose in a single trade and hit the button. Exactly. Now, for people who do not trade with the right mindset, it's just a matter of coming to the market, thinking about how much do I want to make today, or how much do I want to make on this trade first, and then they hit the button, and then, you know, they risk whatever amount they think they need to risk just to make a certain amount of money. But this is not how it works. You have to always come into the market first, thinking about how much am I willing to lose. Then you think about potential returns. If you first take care of the amount you could potentially lose, I can guarantee you that you will make good money in the markets. So now there's a difference between someone who just wagers and someone who actually trades. You want to be the guy who trades, not the guy who wagers. The guy who wagers, I mean, can basically, I mean, yes, we may have heard of different interesting stories about people who made, this guy made $1 million from $100 or $10,000. Those are fairy tales. I guarantee you that somebody who trades with high risk would eventually blow up. That's a fact. So you want to be the guy who, from the beginning of your journey, you have good trading habits. And one of the benefits of being a new starter in this space is the fact that you haven't picked up so many bad habits. So it's best that you start out by learning the right habits and transition from there, and you know, grow basically with the right habits. So, and one of the key ways to do that is to be a trader, not just a wager. As I previously stated, there are people who have made well, there are stories we've heard about people who make crazy money from trading, but I would like to advise that everyone gets into this with the right mindset. The idea for us is not to win the lottery or to win a bonanza, so to speak. The idea is long-term longevity, profitable trading through a proven step-by-step method. And as I previously stated, risk management is the thing that would set you apart. Trust me when I say this, man. Trust me when I say this, guys, because I have been there. So So why is risk management important? Someone is basically asking, why is risk management important? To address this question, I have a very interesting quote, and it goes something like this. Until you get comfortable with losing trades, you would never win. And I mean, some other wise guy somewhere may have said this quote, but I mean, I learned this by a lot of trial and error personally. And I say this because you have to understand that when you're trading, losses are inevitable. I mean, from time to time, even if you have a very, very great strategy, you would have losses from time to time. And you don't want to be the guy who has maybe 10 good trades and then you have one bad trade and then you blow up. You lose all of the profit you've made plus some capital or some other disastrous outcome of not managing your risk. This is why risk management is very, very important. You have to have the mindset of longevity, step by step process that would make you last in the business. Slow and steady really does win the race when it comes to trading. Next, I would like to talk about trading as a business. So speaking of managing your losses, you give yourself a chance to be profitable when you manage your downside. If you do not manage your downside, I mean, you could lose a lot of money before you even get the chance to make money. So risk management, as I always say, would save you a lot of headache in the long run. Forex trading is a numbers game, meaning you have to tilt every little factor in your favor as much as you can. You want to be a rich statistician, not the wager, because in the long run, you want to be a winner. Speaking of trading as a business, you have to develop the right habits and think in a series of trade perspective. Now, I would like to describe this series of trade perspective as a situation where you're not putting too much emphasis on any one single trade. What you're thinking about is, how can I make money over the course of a series of trades, 10 trades, maybe 20 trades, rather than thinking about the now. And what this does for you is, when you think in a series of trade perspective, you're thinking about, if I invest in this particular trade idea, how much could I potentially make? So you're not overemphasizing on any one single opportunity in the market. This is so important. This is one of the things that gets a lot of amateurs in trouble, because they see the potential to make a lot of money in one single trade, and then they go big at it. And I'll give an example in numbers. Let's say you have $10,000 and a particular trade opportunity gives you the potential to make, let's say, $10,000 if you risk 50% of your account. But the same opportunity would give you, the same trade would give you the opportunity to make, let's say, $2,000 if you manage your risk properly. What do you think the right thing would be? I know somebody's mind is telling him, of course, I want to make $10,000. Yes, I also would like to make $10,000, but realistically speaking, that would be a bad decision to make, because if you're risking 50% of your account to make $10,000, that only says to us that you only need 2 bad trades consistently to wipe out your entire capital. And that is not how to manage a business. I mean, I'm sure some of us have, or most of us would have had some experience in business, no matter how little it might be. But I mean, when you buy, when you invest in business, when you trade or do any type of market transactions, you're not like thinking that, okay, this particular transaction, I go buy merchandise from the market and resell, for instance. You're not thinking like this transaction is what will get me rich overnight, right? You're only thinking about how I can make a marginal profit from this transaction. Same thing goes with trading. So the next question would be, how much trading capital do I actually need? Now, this is a highly subjective question and definitely requires a subjective answer as well, because you have to dig deep and ask yourself certain questions to be able to answer this. And one of the, I've highlighted 3 questions, which I'll take you through, that I would implore you to ask yourself as well. And the first one is, am I doing this as a side hustle, or is this supposed to be my primary source of income? So obviously, if this is supposed to be your side hustle, it means that it's only supposed to buffer what you already have, or what your current level of earning, right? So you would probably need less capital than if you're taking trading as your full-time occupation. So that means you would need more capital to be able to fend for your needs with the profits you generate from trading. Another question to ask yourself would be, how much of my money can I invest with a passive mindset such that I won't be under pressure to deliver? Now, what this means is, if I have a savings of $10,000, for instance, how much am I willing to invest? How much am I willing to invest in trading that won't put me under pressure? For some, and again, this is very subjective. For some, it's $5,000. For some, it's $8,000. For some, it's just $2,000. Only you can answer this question for yourself. So this is another key question to ask yourself when thinking about the capital you would need, and how much. And the last question would be, how much would I like to make from my trading? Now, yes, I know, as much as possible. Exactly, I know this. But realistically speaking, right, if you set a figure, then you have to know that you need the capital to match this figure. So someone might say, I want to make $1,000 per month from my trading. That's very, very possible. That's very achievable. However, you would not make $1,000 per month with a capital base of $2,000. You have to have at least $10,000 to be able to make $1,000 a month. This would, of course, be highly dependent on your skill sets and your level of experience in the market. But I mean, for reasonably speaking, if you have $10,000, you should be able to make $1,000 a month, which is about 10%. I would say that's a reasonable figure to target. So if you're sticking to micro lots, generally, I mean, 5K to 10K would definitely be a good amount. I know that not many people would be willing to risk this much for a start, but it is, this is like a comfortable figure to look at. And again, you have to correlate the amount of capital you have at hand to the amount of risk which you would be taking per trade. It's common knowledge that most businesses fail due to undercapitalization, absolutely, and trading is no exception, which is especially true in the Forex business. So if you are unable to start with a large amount of capital, that you cannot afford to lose. Be patient, save up, learn to trade the right way until you are financially ready. Exactly. So it's important that this takes me back to the 3 key questions I highlighted earlier. Number 1, am I doing this as a side hustle or a full-time job? How much money can I afford to invest? And how much am I willing to make? So, I mean, a guy who says he wants to make $1,000 a month, but you only have $1,000 as a starting capital. Realistically, you cannot pull this off. So you have 2 options. You either go back to the drawing board and save up more, work harder, get some more capital, or you realign your mind and your expectations to fit what you do have. So what I mean by this is if you have only $1,000, then you have to realistically expect that you probably only make $100 or $50 a month. Do not try to chase after $1,000 with $1,000 capital. That would be bad risk management. So yeah, next thing I would like to touch on would be the other costs of startup associated with trading. Now, as previously stated, trading is a business and it should be run as such. But there's a unique advantage in trading. Unlike other businesses where, I mean, let me take, again, I always like to use merchandising examples. You're buying and selling, right? You have to get a stall or a shop, or you have to get a space in the mall, whatever. You have to get infrastructure, tables, chairs, you have to hire staff and all of these things. These are all part of your startup cost, right? But in trading, you basically only need internet connection and a laptop, which most people already have. So this is the good part of one very huge advantage of trading. And then the next big cost, and I think the biggest cost involved in trading is actually the cost of acquiring the skill set of trading. Now, this is one of the unique advantages SmartFX is presenting to you. We're presenting the opportunity for you guys to learn from our experienced team of analysts. We're constantly running these webinars to teach you how to trade, educate you. We'll have our social media handles that you can always make reference to. Once you're registered on the platform as well, you get daily analysis, interesting updates about things going on in the markets and all of this. So we are taking care of this, the part of the cost of acquiring the skill set. Now, the next cost would be the cost of capital, your trading capital, because you cannot make money without money. That's how it works in trading. So usually a lot of courses which you will take online are very expensive. I mean, anybody who has done a little bit of research would know that it would cost from anywhere from a few $1,000s to, some even go into 5 figures. And that's really quite expensive. You might opt for the option of learning just via articles, YouTube, and all of that. Yes, that works if you are willing to commit 2 years of your life to learning through the long process. That works. But if you would like a shortened approach, then it would be best for you to get a mentor, and we're presenting this to you for free at SmartFX. So get in touch and we would help you with that. Yeah, so yeah, as a technical forex trader, most of the charting packages that come with your broker's platform is sufficient. Exactly. These are some of the other costs. Some of you might be familiar with the Bloomberg terminal or the Reuters terminal. The Bloomberg terminal costs about $21,000 per annum just to subscribe. But this terminal is mostly used by institutional traders and banks, which is not which you do not need as a retail trader. The good part is the charting platforms you require, your brokers already give it to you for free. SmartFX already has the MT5 platform, which you can plug in for free. For fundamental analysis as well, you have a lot of free materials to read up on, like Forex Factory, The Economist, and the likes. So the next thing which we'll be talking about is drawdown and maximum drawdown. So we know that risk management will make us money in the long run, but now we'd like to show you the other side of things. What would happen if we didn't use proper risk management rules? Consider this example. Let's say you have $100,000 and you risk $50,000. What percentage of your account have you lost? 50%. Can you just imagine having $100,000 or even $1,000 and then you risk $500 on one single trade in the aim of maybe making $1,000? You risk of $500 and you lose 50% of your account. Trust me, you would lose sleep, you would lose, you would be stressed, and all of this, that state of mind would only put you in a situation where you want to take more risk, and it just becomes a cycle. I call it the cycle of doom, where you have to take more risk to recover your previous loss, and it just goes on and goes on and goes on like that. You can avoid this by simply managing your risk properly. Now, a drawdown, I would use this diagram to explain to you in simple terms, what a drawdown is. Now, if you see this point, this is the peak, the highest point that your capital has gotten to, right? And this is the through. So your drawdown is basically the distance between the highest capital point you've achieved and the lowest points you've achieved. So your peak to through is what we call your drawdown. Again, giving another example in simpler terms, you have $1,000. You've built your account to maybe you've earned about $300. Now you have $1,300. And then maybe you take one bad trade, and then you're losing about $500. That means that now your capital is at $800. So your drawdown is now $500. Now, keep in mind that I am not saying that losses are bad. I actually sometimes enjoy taking losses because you only learn from losing trades. And losses could come either from making bad trading decisions, or it could just be as a result of market conditions, bad market conditions. Your strategy would never be right 100% of the time. Now, risk management is that one thing that would ensure that even when your analysis doesn't go as you expect, it's never a disaster. So risk management is basically a disaster control tool, as I like to put it. Next thing to talk about here is your edge. What is an edge? And in speaking to this point, I would like to again introduce I would like to introduce something I call the golden rule of trading. Excuse me. I'd like to introduce something I call the golden rule of trading, which is the 3 M's of trading, which is method, money management, and mind management. Method simply is the strategy which you would apply to make money from the markets. Whether you're using a technical methodology, a fundamental methodology, or a mix of both. The method is just, for a technical methodology, for instance, it's just a set of rules or a set of criteria which you want to see align on the charts before you take any trade. That's simply what your method is. Money management is basically another name for risk management. How much you're willing to lose at any one time and how much you could potentially make for every risk you take. And the last is mind management. Mind management is basically what we call psychology, the psychology of trading, how you manage your mind to ensure that you are executing your methodology correctly and you're following your money management rules. The psychology of trading, which is mind management, is another very interesting topic that I love to talk about because it's something I also struggled with along my journey. So my personal research brought me to a point of enlightenment, as I like to say. And a lot of these things I would be very happy and willing to share with you guys in another session of our webinars. So the combination of these 3 M's of trading, which is method, money management, and mind management, is what I call your edge. Now, understand that every trading system, every edge, every methodology would have losing trades. Now, if you have a 70% profitable edge, that is actually a very fantastic position to be in. Now, so theoretically, right, having a 70% winning strategy would mean that for every 10 trades you take, you expect that you should win 7 and probably lose 3. However, something very important to note is that we do not know which of the 3 trades would be losers and which of the 7 would be winners. Every time anybody is placing a trade, I'm sure the expectation in their mind, nobody ever places a trade thinking that I'm going to lose money on this trade, right? The expectation usually is, I take this trade, I will make money. But also, you have to approach it with the understanding that this trade may just not go my way. I might have a blind spot. There might be something I haven't considered. A news might hit the market and change the dynamics of everything I expected before I took this trade. I may have ignored a vital point about my strategy before I took the trade. So there are like 1,000,001 reasons why a trade could go against you. Now, the point is never to allow any single trade be a disaster. And this is why you have to manage your risk in relation to your edge, no matter how good an edge you think you have. Also, with the understanding that losing streaks are normal and they would come. The only question is, when will it come or for how long will it last? Now, again, risk management is here to protect you from the potentially disastrous effect of having a losing streak. So yeah, speaking of losing streaks, coming up with a trading plan that enables you to withstand long periods of losses is basically one of the key things risk management will do for you. Now, the next question is, so how much should I risk per trade? A lot has been said about don't risk too much per trade. take just the amount of risk you're willing to lose and all of that. The question now comes, how much should I risk per trade? Generally speaking, I mean, irrespective of your level of experience, expertise, 2% sounds like a reasonable level. However, I would actually advise that you probably even risk less if you're a newbie. If you're just coming into the markets freshly, you could keep your risk at just 1%. Now, if you have $1,000 and you risk 1% of that, that's about $10, right? You won't lose sleep from losing $10 on $1,000. I'm sure you'll be perfectly fine. And that would still give you the confidence to go in for the next trade. And you never know, the next trade might be a big win that could earn you $50. You know, one of the problems with taking too much risk, if you have $1,000, for instance, and you go risk about $200, one of the problems with that is if you lose $200, you're not thinking straight anymore. You're only thinking about how can I make my $200 back? And that just puts you in a state of mind where you want to go out and risk more. You know, you're not thinking about, okay, now I fucked up, let me go back and risk my $10. If you go back and start risking $10, it might take you, you know, maybe 5, 10 trades to be able to recover your $200. So naturally, you'll be like, you want to risk another $200 just to make your money back. And that will only put you in a cycle of doom. So my advice would be that keep your risk at 2% or less. 2% or less. And we would explore this idea with this table. Now, on my left here, you have a table, a starting capital of $20,000 and a risk per trade of 2%, while on the right, we have a starting capital of $20,000 and a risk per trade of $2,000, which is 10% of your account. Now, after 19 trades, risking 2%, let's assume that a person has a losing streak of 19 trades, you still have $13,903. Keeping in mind that every time you lose money, we are calculating 3% of your new capital, you know, like that. While on this other side, risking 10% would mean that you are losing, you would have lost about $17,000 at the end of 19 trades. So, I mean, logic would say that the lower your risk, the more longevity you give yourself, the more opportunity for longevity you're giving yourself in the markets. Now, you can see that there's a big difference in risking 2% of your account and risking 10% of your account. So you want to do your best to keep your risk as low as you want, as possible. As the diagram showed, after 19 losses, you only lose about you know, a small fraction of your account, while if you're risking 20% per trade or 10% per trade, you would have lost 85% of your account. You don't want to be that guy, trust me. Now, the next thing to talk about here is risk to reward. I call this the second leg of risk management. Risk management basically has two legs. The first leg is how much you choose to risk on a single trade. We've said that you should keep that at 2% or less. The second leg is the risk to reward. Ideally, I would highly recommend that for every trade that you take, you should have the potential to make 3 times whatever you're risking. So if you're risking $1, you should be able to make at least $3. If you're risking $10, you should be able to make at least $30. If you're risking $100, you should be able to make at least $300. And this is basically what we call risk to reward. Keep in mind that the most important job a trader has is to be a professional risk manager. This is the way I like to see. Because trust me, if you manage your downside, you manage how much you're willing to risk, the profits would automatically take care of itself if you continually follow the right methodology and steps. So yeah, and here again, this diagram will show an example of 10 trades. You lose 1,000, you take first trade, you lose 1,000, second trade, you make 3,000, third trade, you lose 1,000, fourth, you make 3,000, fifth, you lose another 1,000, on and on like that till number 10. At the end of 10 trades, you would have lost $5,000 while you'd have made $15,000. So you've actually earned your loss 3 times over. So you can afford to lose 50% of your trades and still come out very, very profitable. You know, this is the beauty of risk management. So in summary, risk management has 2 legs, just to reiterate. The first leg is how much you choose to risk per trade. And the second leg is the risk to reward on each of those trades that you take. And remember, you want to be a statistician, not a wager. You don't want to blindly chase the dollar. You want to be more calculated and follow the rules, basically. Study your losses to realize gains. Yes, very importantly. I'm sure a lot of us are readers, so you would have heard from a lot of successful people. They say that they learn more from their losses, their business mistakes, and all of that than from their wins. And this also perfectly describes risk management. You know, you want to learn from your losses and build upon those so that you can be more successful. Traders are often so fixated on their winning trades that they totally ignore losing trades. But it's from losing trades from which we stand to learn the most. Absolutely. And a very brilliant quote here that goes, the goal of a successful trader is to make the best trades. The money is secondary. Alexander Elder. Absolutely. And I believe I have mentioned this like over and over in the course of this webinar, that the money will take care of itself. Your primary objective should be to take care of your losses. Now we're getting to the end of this. Just one more thing to touch here is leverage. I believe we talked briefly about leverage and margin trading in last week's webinar. If you haven't seen it, please go check it out. It's on our YouTube channel. Leverage has the ability to amplify your gains, but it also has the ability to cause you large losses. Now, a good trader ensures moderation. Remember, if you take care of your losses, your profits will take care of themselves, of itself, basically. So don't set yourself up for failure, guys. Do the right thing, manage your risk, start out with good habits, and I can guarantee you that you would have a very, very life-changing position from trading. Trading can make your wildest dreams come true, but you have to do it right. And risk management is basically the bridge between success and failure if you take it seriously. So thank you guys for staying with me through this presentation. Now it's time for our question and answer section. Anyone who has any questions should please drop your questions, and I'll be happy to address them. We'll give it about 1 minute to see if anybody has any questions before we end the session. Just to reiterate, please follow our social media handles. You get regular updates on market happenings. You can connect with me directly on WhatsApp if you have any questions after this session. For those who have some sort of experience and are looking to develop on their skills, reach out to our team of analysts, reach out to me directly. I'll be very happy to help you. Okay, so we have a question that goes, what is the best time frame to trade as per your experience? Well, this is another subjective question, because different strokes for different folks, basically. And we would have a more detailed session on technical analysis, multi-time frame analysis, and all of that. But just to give a direct answer to this, my personal belief and from personal experience is the higher the time frame you go, the better for you, because you would be able to skip a lot of noise in the probably daily fluctuations and all of that. So the weekly and the daily timeframes, I would say, is a very, very comfortable time frame for you to look at the markets from. It gives you a bird's eye view and helps you to, exclude a lot of noise, basically. But we'll have a detailed session on technical analysis, so please stay tuned. Okay, so in the absence of any other questions, we will be looking forward to have you. Thank you for your question. So in the absence of any other questions, I want to thank you guys for joining and staying tuned till the end. And please ensure to join our session next week. Go over to our YouTube channel and check out all of the other beautiful sessions by the rest of our experienced team. And again, reach out to us directly and we'll be happy to help you with whatever you need. Thank you guys very much. And I wish you all a wonderful day, a wonderful trading journey, and see you again next week. Cheers.